You will not believe what the Federal Reserve and Jerome Powell just said about the US economy, and how it impacts all of us as traders and investors moving forward is going to be very important. Also, on top of this, have we just drawn the battle lines between the bulls and the bears, with the big sell happening right on the press conference discussion when Jerome Powell opened his mouth? Well, one thing's for sure, we've got crashes across crypto, a pullback after a 40% move up in Tesla. Which levels do we like? And we're practicing abundance around the world because there are some markets doing really well that we've been discussing, and it looks like there might be another one. Join us as we cover stocks, commodities, and cryptos for today. Well, welcome back everybody to the Daily Show. My name's Tom, and today we're going through the macro, the data, as we always do, and of course the lead indicators and the hottest charts. Let's get into it straight away though, because it was semiconductors down and the market continues to get led by this sector. Now, you might think it's the strongest, but today we're going to go through why it's still looking a little bit shaky. So remember, subscribe and smash that bell icon as we go through and show you how this economy really works together. So let's talk FOMC, because of course this was the meeting that everyone wanted to know about, and every single person was coming in expecting some hawk discussion. That is the idea that rate hikes might be on the horizon. Now, in general, the FOMC meeting minutes showed that they would be taking on some signals of the recent inflation data. They were supposedly pulling back a little bit, but I think it was more just a wait and see. And the big discussion here was when people said, what about the next move? Could we see rate hikes? Well, Jerome Powell said, no, pretty much. Unlikely the next policy rate move will be a hike, and he is confident that policy is restrictive. Now, this is what he's saying, but let's be real. Are we actually seeing restrictive policy in the markets? I would argue absolutely not, and we'll go through that a little bit later on. But in terms of what I'm seeing here is the juice is still flowing and debt is still being lent by the banks. And I think you're wanting to watch XLF as much as possible and KRE throughout the next couple of years, because if they continue to expand, you've got to continue to be generalized bullish on these markets, as effectively that's showing you that the overall system is nowhere near as restrictive as you might think. If you've got record bumper profits on the banks, then that usually means something's going on underneath the hood that's a little bit sneaky. So financial conditions, have they technically tightened? Well, according to some of the data, you would say yes, they have, and they've become a little bit tighter in recent times. But realistically, I don't think they have as much as people would say. And you can see here that the funds markets moved a little bit towards the downshift, and it's a little bit lower now than where we were just a few days ago. Basically, they're saying that we might get some rate cuts starting at the end of the year and then leading into 2025. I think the most important thing here is not so much even the rate cuts, although that will show you. Remember, when the Federal Reserve does a rate cut, something's totally broken in the markets usually. But it will be all about watching those yield spreads, the US 3-month and the US 02Y versus the US 10. Now, if you don't have that on your charts, put it there. Inversion of both the US 3-month, so that's US 03MY versus US 10-year, and of course, the US 2 versus 10-year. When that happens, we posted this over on X, generally the next 3 to 12 months, you want to be ultra cautious because it's showing you something is totally broken behind the bars. Now, you'll watch price action ultimately there. Sometimes you can get an epic run up similar to what you got in 2020 and other periods, but never lose sight of the inversion yield. Now, a lot of people say it doesn't work anymore. I totally disagree with them. It always works. It just takes a long time to play out. And this one's been over 500 days in inversion, which shows you a very powerful force is behind whatever's going to happen in the future. Speaking of that, though, what are we thinking moving forward? Well, of course, we did just see a big rally into a big sell from the technology markets, and we haven't had one of these for a little while. In fact, the last time we were getting a lot of reads like this was back during the sell-off in 2022. Now, when we got these reads, they did usually lead into a little bit more selling before we ended up getting buying. Am I terrified? No, I don't think we need to be terrified, but a lot of signs are pointing back to some demand zones. And with that huge wick that we'll see on the S&P 500 soon, we might be looking at maybe a little bit more volatility, especially if Apple can't live up to expectations and the market chooses to sell through non-farm payrolls. Be ultra aware of two levels that we're going to bring up today. Also, have we seen a very volatile year? Well, the answer is quite simply no. In fact, if you look at the percentages, we're only 7 days total in terms of markets that have moved -1% plus over the SPY, and that's since the start of the year. So you still expect a lot more volatility this year being an election year, but in general, we're still looking towards that bull side. So I think it's very important as an investor, as a multi-month trader, you want to be looking at opportunities still to the upside as we are not seeing restrictive markets. And that's probably also detailed by the momentum we're seeing in hedge funds. Hedge funds are piling in, leverage is starting to appear back into the markets, and really dips are being purchased by some of the biggest players in the street. We'll look at the CTAs in a moment because, of course, if the 20 weekly moving average is closed below, we have to expect them to come back to what we call equilibrium. And then if that happens, we're looking for nice buying off that zone. Another really good lead indicator that could help us. So which sectors should we be looking at? Well, we've argued that, energy's been really good this year. Of course, I've been a huge fan, and we all have, of copper. And we've been a big fan of many, many different markets. But the rise of utilities, which is currently in a little bit of a weak bull market, it's getting started, is starting to look really, really nice. And you'll notice in recent terms, we have 92.9% of utility stocks above their 50-day moving average. Now, that's a very strong movement out. And if you look at it on the charts, utilities are starting to look the best. Over the last 3 months, it's been, over the last 1 month, I think it's been one of the best sectors, if not the only sector that's up. And healthcare and consumer staples have not been showing the same signs. So what that's telling you is it's not just defensive nature, because this is the main defensive kind of sectors of the market, but there's also something else going on underneath the hood. And I think utilities is potentially a benefactor of underinvestment for a long time, a relatively cheap PE, and people also looking at it as maybe some kind of proxy AI play due to the energy consumption of that type of stuff moving forward. So let's have a look. Is it cheap on the horizon? Well, utilities is trading at kind of what I would consider a very fair price. Of course, we do expect at some point the utilities will trade up into the 20 barrier, which it's done several times before. That gives you a 5 forward PE ratio or a decent amount of percentage, in terms of increase. And I think also if we're looking at what the market's saying, the market is starting to look at utilities as a growth rate rather than a failure rate, which it usually has been. It's usually been pretty slow. So it looks like there's some forward projections coming out that show utilities are going to do a little bit better. And that's surprising to a lot of people. I would call it late cycle investing, and we'll be wanting to watch utilities a lot through the next 2 years. It might be the most boring sector to many, but at these points in time, it can be well placed if you do the right things. Let's talk about why else that might be interested, or why we might want to look outside the Magnificent Seven. Is a portfolio of the 3 pillars as we talk about it, or anything to do with the Mag 7 pretty good? Absolutely. It's excellent, of course. Anything to do with AI right now will come back, in my opinion, and we're on the forefront of some very interesting technology, and expect all sorts of random stuff to come out over the next couple of years. I'm also looking for IPOs in this area to start to flow through maybe into 2025, and maybe that's going to be a huge IPO year as we get past the election year, past those concerns, and then move into kind of like I would call mania around this area. But S&P X Magnificent 7, this is where the growth supposedly is meant to happen throughout the earnings seasons moving forward. So definitely keep watching that. Also, it may be worth watching some of the markets outside of America, because of course we love American market. It's the best. It's got the best AI. It's got the best everything. But as we've recently been talking about, there's been some huge movements inside of the Chinese stocks, and everyone's been super negative on it. Here on the channel for many months now, we've been going on about the price action looking better, and just another case of this. While all the markets in the US were kind of looking a little bit weird, we had another uptick in things such as KWeb, HSI, etc. And you can see here now the returns from February are really in the favor of some of the overseas markets. This also may go through to emerging markets moving forward as well. So, this will be something that we do a special on, as we're seeing emerging markets versus domestic markets start to bottom. And it's been a long time, a lost decade and a half in terms of the last time we saw emerging markets actually perform well. It's interesting times, and it's certainly exciting times throughout that. So as we mentioned, it was about the speech. So we had kind of like this 2:30 read where it went good and then went really bad on the market. So effectively what happened is Jerome Powell started talking, and whatever he said, whatever the market algorithms were trying to bring out, they were basically like, whoa, this is not what we expected. Notice what was leading though. We saw regional banks doing really well at the beginning. And I think what this is showing you when you look at regional banks, when you look at financials, is we are not as restrictive as you might think. Also, utilities coming out of nowhere, one of the best performers on the day. And also IBB, usually that's to do with rate cuts on the horizon, you would think there. But semiconductors and technology and even energy as oil broke through one of our key supports and is moving towards a really great zone, they were all down pretty hard on the session. So if we have a look at the last 5 days, you'll notice here that you wouldn't probably have guessed that clean energy would have been the number one, but it's kind of trading, I think, in proxy with utilities, and also solar is up there as well. But XLE, anything to do with oil at the moment, is worst. And then, of course, we've got technology, and semis are now down across the board. So how does this look in terms of the charts? Well, let's break down the S&P 500. So here we have a 20 and a 50 moving average on the charts, and you'll notice both of them are coiling at around this 5100 level. Now, as we already mentioned, 5100 was a move towards from negative gamma to strong positive gamma in the options market. And that's probably the most important thing we're watching right now. Where are the options? What are they telling us about the markets? But when we have a look here at the S&P, it rallied up and it went into that kind of 50-50 to 50-80 zone, which we spoke about in the previous video, and rejected super hard, closing near its low. Now, at the time of recording, the market's up a little bit more, but I've got to say that is a very negative looking candle, and it does insinuate that there is further selling moving forward, especially if we make it to a new low underneath that previous close. So we'll look at that in a moment. If we manage to break through here though, and we go to a new high, I believe it'll be a squeeze. So we've kind of gotten some very good levels now from that FOMC meeting minutes. We've got effectively the 5100 zone break above, positive gamma switch, all of those good things. And then we've got the continuation if we move down, because that is a negative looking candle right there. If that then goes through the weekly 20 moving average, which you may or may not be familiar with, this mean reversion, then that can create what we call a cascade or a waterfall effect, where effectively markets start to freak out and they move very quickly to the next zone. Now, where is the next zone? We've long thought about it at the 4,700 to 4,800 area. And that's because we've got a 50-week moving average there. So if markets do continue to weaken and they break through this area here, we in a negative gamma environment that tends to feed upon itself, and then we get to the 50. Now, is that scary? Is that terrifying? I don't think so. Like if you go back through history, the 50 is an amazing moving average, as is the 20. In incredible bull markets, you only get the 20. In bull markets that have a little bit more technicality to them, you tend to get more of the 50. Now, you might say, well, it's all stuffed. It's all going down right now. I think that the Fed is clearly, we're seeing, look, let's face it, we're seeing relatively decent strength in the economy, if we can believe that. We're seeing a non-restrictive Fed realistically, which is helping juice, of course, the debt markets. And all of the things are pointing towards, at this stage, this being still part of a corrective pullback. Now, let's have a look at the futures and go through what happened here. So market came up to that level. Of course, I thought that we would probably sell around 50.70. This is something that I mentioned in the previous video. Around here made sense. We pulled the fib. It actually worked out pretty well. So if we actually grab a fib, I'll show you what I mean. So if you pull a fib from the high to the low here, this was kind of where I was thinking that the market would sell. So if you can put it around there is where I thought it'd find a sell. Got a little bit higher. Stop losses would have held above the high, and then it just got hit right back down. Now, it's that ferocity of hitting it back down that then says, okay, well, if we make a new low and we go underneath 5,008, which was the previous session low, then this is where you're going to start seeing, what you could have, which is a really bad negative gamma kind of movement. So this is very, very clear lines between the bulls and the bears. A movement above here, bulls are in control, squeeze, pullbacks probably met by bull demand. A movement below these points, especially below 49.80, that's starting to point towards getting through the 20 weekly, which we know historically has bought those other levels. If we go even smaller time frames and we have a look at what happened during the 5 minutes, you'll notice the bears certainly did win the session because they managed to completely plow all of the bulls back down, but they weren't able to take it to a new low. So that's why I think this is a great alert zone for us to be watching over the next 24 hours, as is, of course, a new movement to the upside. So let's take a look at the overall 0DTE options, because, of course, this is where the magic lies sometimes. And you will notice that there is a lot of negative gamma all of a sudden. All of a sudden, we got heaps of negative gamma. We moved to positive for a couple of days, couldn't quite squeeze through that zone, and now we're seeing negative gamma everywhere. Notice the 5,000 level. It's everywhere on all of the charts moving forward. So if markets can't hold these zones, and you'll notice that it's between about 50-50 and 5,000, 50-50 and 5,000, that we have all these puts. If we start to push through and we make it underneath that 5,008 zone, can you see now why there may need to be hedging that's going on? And that can cause that cascade or selling effect. And it starts to feed upon itself, at least in my opinion, underneath those levels. So a very important Apple earnings, a very important non-farm payrolls earnings. Bulls could still be absolutely in control. Would I freak out if I was an investor? I totally wouldn't. I don't think it's worth freaking out when you've got still fairly good news around you, if we, again, believe those bits of news. And the market is perfectly positioned for, it's okay to move down around 10% in a election year. In fact, that's the average, and this tends to be the time that usually happens. Now, what about CTAs? Did they continue to position up? Well, the answer is no. So CTAs did drop a little bit over the last 24 hours, and you'll notice CTAs also dropped their NASDAQ positions a little bit. Pretty normal. They love bouncing the 20 weekly. They love bouncing the 50 weekly. They obviously will end up, moving down and continuing to sell if we get below the 20, because then they'll go usually towards the 50. So this makes, again, perfect sense at the moment. We'll update, watch the price. That's the most important thing. So I thought I'd share a couple of little interesting charts on X. So follow us on X if you're interested. This is where global production in 2023 came from gold. So you can see China is doing the best in terms of getting the most amount of gold. The US actually behind Australia over here. Australia at 310, similar to Russia. And yeah, gold, I think, is going to become a very important storyline over the next couple of years. It already has, but I think it's going to continue. And obviously, we've talked about the idea of $3,000 an ounce for quite some time. Let's just discuss the Hang Seng for a moment, because, of course, there are opportunities everywhere. We just got another great sign that the market might be turning its base. And, of course, we've talked about this for a while, but this tends to be a bit of a bear killer. 20% drawdown. It's shown now a breadth thrust over the past 2 weeks. That's very strong. Breadth is improving. Sentiment still bad, still in the gutter, but policy clearly shifting. And we've got what we call the China put that's kind of in the markets at the moment, which is when they come in and they start doing all these policy shifts that we saw over the last 2 months. That usually brings a put market in there. If we take out the outliers here, it is on average something like 9.95% possibility of down in terms of the overall markets. So pretty normal there. And of course, election years, we usually expect, if we've had a very strong start to the year, this to be the tumultuous time, this to be the scary time, and then maybe a secondary dip somewhere about September, October, as you can see here. So yeah, I think it's pretty normal. If we do end up moving through the 20 weekly, we do expect that in all the correlations we've seen, the two most correlated being these markets, that they end up coming out very strongly. So again, I don't think that there is something to be super ultra terrified about this year. It's just a normal election year, at least the way it's playing out from the other correlated zones. So what about earnings? Well, Apple is coming out. This one already looks kind of bad on the charts. We'll look at it in a moment so we can check it out. Will Apple outperform? We'll have to find out. Do remember the options market is expecting a plus minus 4.5% move. So it's going to be a pretty big move. But let's get into the chart straight away. VIX holding above 15, still showing signs that bears could be in control. Overall, the options market for bonds showing a little bit of a spike up, still not super concerned. So again, showing that the markets are still maybe buy the dip in this situation, except that you want to be actually buying quality movements, not just random movements. You've got to put your own risk there again, guys. And then we saw the high yield junk bonds not necessarily react super negatively over the last 24 hours. On top of this, Jerome Powell comes out, says everything's restrictive, everything's bad. And then all of a sudden, central banks around the world show the first sign of injection back into these markets. Now, we've seen this all before. We know that they all claim that it's restrictive and then they inject back in. So central bank markets actually showing some overall support of the markets over the last 24 hours. Dow Jones Transportation Average, home builders, all of those things did drop. Dow Jones obviously are not a great looking sign on the charts. And another one that you want to set an alert for at about 15,087, because if it breaks above there, it's a big level. Copper, very bullish on copper. We love copper, but I do think it needs a bit of consolidation around here. Longer term average, I believe it'll be up, but for now it kind of hit into our key resistance. So I could see that kind of struggling now. Now comes the interesting one, the dollar index. So it got crushed and move straight back down. Now, this could be the beginning of a Wyckoff distribution, but it also could still be the flag. So you can see here the flag, no low was taken, okay? So no low, we don't have clear evidence either way on dollar. And as we expected, this week's going to be very important. Non-farm payrolls coming on Friday, which is the jobs numbers. If the dollar is able to break back above and it gets through that 106.50 zone, I'd say dollar is going to fly pretty high. If dollar fails here though, and it does something like this during non-farm payrolls, oh wow, it's going down. So I think this is a case of being patient, and we are going to get a reaction, I believe, on the US dollar. So we'll see how that plays out. Now, because it was dollar down, gold strengthened, and this is the last line of resort for gold. If it fails here, which I thought it might have failed over the last 24 hours, didn't look too good, then it's probably going well lower for the time being, and we might be moving into like 21.72 or something like that. I'm going to love gold at that level. If you are gold bull and you want to get back into markets or you're looking at trading, I think the key is going to be around 23.52. So we'll be watching that very closely on the charts as well. US oil, almost down into our great bull zone. So it collapsed. This was, of course, something we discussed. After we gave up that position, we thought we would go down into this red box. We're not quite the red box yet, so I'd like to see it go down a little bit more. 78, very key level for oil. And I expect bulls to try to recommit around this area. So hopefully we see some strength coming back into oil very, very soon. What about Tesla? Everything is as normal. We expected this. The resistance, which we pinpointed, very nice, guys. And of course, the market pulling back. There are two main zones. There's a 61.8 of the whole pull, which is certainly a key area. And then, of course, there's this most traded zone around 173 and the ribbons of many moving averages. So I think there's still more to come from Tesla down. But I think also traders and investors will be looking at these levels as bull. As usual, I like to see structure, so we'll be looking for structure on the charts. What about Apple? It doesn't look very good. I mean, lots of rejection wicks. Of course, if it manages to snip that off with a earnings report that bulls it through 178, that's a great sign that Apple bulls are fully in control and that a lot of shorters are getting squeezed. But on the surface of it, if you're looking at a chart like this, you're not going to love it. Came back to the 20 moving average, found a big rejection short. It's still in a downward trend for now, making a series of lower lows and lower highs. So you can't really love Apple until the earnings announcement makes a difference. Also, I thought I'd update with AMD. So AMD did make a new low, which I suspected it would. And then it just kind of like held there, right on that 61.8 retracement. Now, that doesn't give us enough yet, but I do think AMD will give a potential trade, just like Meta will probably give a potential trade moving forward. So we'll keep watching it. We'll keep bringing it up and see how we can go with that one. Now let's move over to SMCI. So this is where I thought a bull might try to pick it up between the 61.8 and 75. I did expect it to drop off more. It obviously dropped negative 14 at one point, probably negative 16 or 18%. So yeah, down quite a lot. This is where you expect a bull to try to recommit to SMCI. Obviously, if the market goes lower, that is, we fall through that 5,008, then we're probably looking at maybe down into here. And this is exactly what we expected over here. We've talked about this for months. Semiconductors are not leading after this occurred. And although a lot of people believe they were, they're not. This is a great pullback in time, though, and a bit of a pullback also correction-wise. So, people that love AI, you should be getting more excited about the market because it's repricing itself. Remember, time is the most important asset in the markets, and it is doing that. Semiconductors versus the SPY, you can see the drop-off here. And, of course, that led on to things like, we'll just quickly go over NVIDIA here so you can see it. That led on to NVIDIA selling, but it's still very strong in comparison to the other semiconductors. And it's still quite a while away now from earnings. A month or so until we get earnings. When is it? 22nd of May. So quite a while. That'll be a blockbuster day. Could we get down to the magical 680 level? It's possible. Again, 20 weekly moving average must be closed below in terms of the S&P. Now for abundance, well, there's been other markets out there. As we mentioned before, utilities is looking pretty good. So is HSI. And HSI has been very strong now for a little while, bouncing back after the rest of the market. If you actually put utilities on, kind of in some ways similar charts, you've got breakouts of downward trend lines and, of course, nice strength. And utilities is coming out to key res. HSI hit the key res, pulled back, and then, of course, it's still looking strong. So there could be a lot more in there. I think 20,000 isn't out of the possibilities over the next coming months. Aussie 200 holding better than most of the markets around the world. Why? Well, because the FTSE and the Aussie have a lot of banks. They have a lot of energy, and they have a lot of metals and precious metals and dirts and all of those types of things. So yeah, Australian market holding up relatively well. Now let's move to the US market. So US 2K, the actual smaller caps, not doing too badly. You'll notice they're actually showing signs of recovery because it was a semiconductor-led sell-off. So it was really just like semis down due to maybe the earnings or whatever, and the rest of the market was actually holding relatively well. And you can see that really by the US 2K. So it came down to the bull level and it found some buyers. So yeah, we're looking for it above 2020 to show us bull momentum still in. And that's probably going to also mean the US 500 is going to be pushing that positive gamma situation above 5110, 5120. NASDAQ, similar, sold off, same levels. Everything's the same on the NASDAQ as it is on the S&P. And if we get new lows, then we can, worry and bears might rejoice. And while we're above that point, we're kind of, showing that the bulls are trying to pick it back up. Now let's move over to Bitcoin. So I might have made a small mistake here actually when I was talking about it. I kind of discounted the 57K area, and I wrote on X, so definitely follow us there, that I think the 57K area was pretty good. And what we were looking at is, of course, the overall pullback. So there is quite a lot going on here at the 57K. I can see why it stopped here. It's kind of like the hidden market level that a lot of people don't see. I'm sure some of you do see it. So it's a 20 weekly moving average, which we've seen kind of almost bounce a few times here before. So similar to semiconductors, it's a pretty strong zone. It's a 75 fib of the overall move pullback from this point over here. And if it does let go of this position and we end up moving down, then of course we get the 52K, in my opinion. Now, it doesn't look good on the charts, but I can see why some people might think this is where the buyers come back into the crypto market. And if you look on the small time frame, it is trying. It hasn't been able to do much yet. A lot of this is going to come back to the stock market, I feel. Like if risk off comes in the stock market, we're probably going to see further flash crashing down to 52. But this is worthwhile watching. 61 and this area here at about 59.5 are the zones to watch for the crypto market. So certainly some things going on there. Just remember, this week is still about news. We've got Apple, and then, of course, we've got non-farm payrolls on Friday. Expect volatility, guys, around the world. So it's going to continue to be a volatile time. Remember to subscribe, smash that bell icon. And as always, if you wish to, follow us on some of our other socials as well. If you want to find out more about some of the courses and things that we do, we just ran a sale that we extended due to a few people really wanting to get hold of it. I think there's some great stuff in there. We've got some amazing feedback from you guys, and you've been kicking some ass. Thanks so much for watching. Have a great day, and we'll see you in the next one. Bye for now.